So I've got as clear a view as I could possibly have. Nothing is certainty, but for me, the macro is rolling over. By that, I mean we're going into recession. We should see the things like the ISM survey and other things start falling apart pretty quickly. The forward-looking elements are falling apart already. We're seeing it globally. So that's growth evaporating. Alongside that, everything else from the raw goods then comes into the supply chain and then eventually starts fading. So we're going to see that inventories, because people build massive inventories after COVID. Those inventories are now unsold because of the economy slowing down and inflation eating disposable income. We've just gone through the largest tightening in financial market history because the rate of change of interest rates going up was the fastest ever. Mortgages are back to where they were in 1996, and shocking. Then the dollar went up at a rapid clip, which is a tightening of financial conditions, and then commodity prices went up. So basically everybody's suddenly skint, as an Englishman would say. Nobody's got any money, and the economy implodes. So one of the reasons crypto, digital assets, went down was because discretionary spending came out of the market. So if you think of the legions of dollar cost average retail investors, and just think of their rent or mortgage payments went up, their shopping bills went up. So suddenly, or if they were foreigners, the dollar went up. So suddenly, how the hell can they buy as much dollar cost average in crypto? They don't. So they stop. So when liquidity is more available and cheaper for them, they can apply more leverage essentially in their portfolios. So what we end up with was a position where the thing that correlates to crypto markets overall is some definition of liquidity. And you can use M2, global M2 year on year. That looks pretty much like Bitcoin year on year, or crypto market cap year on year. So forward-looking assets like crypto are picking it up. So they also have perfectly correlated to the turning points in the inflation cycle. So they kind of time the bottom, and I think it's time the top. So basically, I think crypto is saying, okay, inflation has now peaked, and therefore the marginal pressure from tight liquidity is gone. Well, the equity side of the equation, that correlation with equities was actually a correlation to liquidity. They're all actually correlated to the macro cycle. Can equities sell off further? Yes. Can crypto decouple? Yes. We saw that in March 2020, that crypto started going up when equities were going down because crypto is more forward-looking. However, equities have actually priced in quite a lot already. So it's not 100% clear whether equities need to go down or not. Okay, I'm going to say something contentious. I think inflation is negative in 18 months. So what we're doing here is we are seeing the tail end of what happened 18 months ago. I think that's going to be dramatically reversed because the supply chain issues are really not as bad. Now, there are issues within commodity markets, like oil, where we haven't had enough spend. But I don't see a massive increase in demand for oil. Chinese economy is slow. I see a supply story, and there's a lot of people looking at commodity markets going, yeah, oil's going to $200. Yeah, if you can get demand back to where it was, we're assuming it is. And people are extrapolating demand post-COVID, which was a stop of demand, re-release of demand coming back on. That demand goes back down to trend. So I don't see it. So I'm guessing that as oil comes down to $60 or so, as everybody gets washed out now, most commodities are down 50%. How fast does it recover? Well, maybe it recovers reasonably quick because of the supply issues. And after a recession, there's a recovery. Are we going to go screaming through $120 and have rates of change that lead to inflation? I just don't see it. Now, the other argument people have is reshoring. If anybody's looked at what Elon Musk has just built, and I published this in Global Macro Investor, the video of the drone going through the Gigafactory, there is a gigantic, massive factory. Well, in the video, there's not a single person. It's all robots. Right? This is not wage inflation. This is not, and the efficiency of building a factory now is not as commodity intensive. And it's not like we're entirely rebuilding countries. So I know the narrative is incredibly strong, and I sound like a lunatic by saying, well, it's not going to be like that. I strongly believe with an aging population, massive debts, and recession dead ahead, the ability to generate persistent inflation going forwards until the end of the next business cycle. There's always inflation at the end of the cycle. The end of the next business cycle, sure, inflation will be high again, the Fed will be raising rates again, or doing what, maybe they won't raise rates ever again this time. But then eventually you go to recession, prices fall. What we need to normalize for is population age, amount of debt. Right, so I look at the real 5-year real rates, which is the 5-year break-even rate minus the 5-year bond rate. That has been trending down for 20 years and has been negative for the last 10. So if I think normalizing rates, I think real rates need to go back to negative 1%. That's what I think of normalizing rates. So negative 1% with, call it a structural 1.5% inflation, bond yields 0.5%. That seems about right. And that's exactly what we've seen in Europe, exactly what we've seen in most of Asia, Taiwan, South Korea, all of those countries. It's exactly what we're seeing in Switzerland and what we've seen in Japan. And also, there's another secular trend, which is everything is getting digitized. Everything that gets digitized goes to zero in cost. Every single thing. And one of my hypotheses is, as we digitize electricity, essentially, by going away from fossil fuels to other sources of renewables, we will see the cost of electricity collapse. I mean, this is actually the breakthrough of digital assets. If everything in the digital world goes to zero in value because of excess abundance, i.e. it's all supply, without blockchain, kind of you're totally screwed, because it was everything disappears in value. But with blockchain, you've actually cement value in the digital world, which was an impossible task beforehand.
That is interesting. Yeah, I mean, it also, and this is part of like my thesis and Arca's thesis is in essence the blockchain allows for to increase the velocity and productivity of those assets, right?
What it did do is the classic, and as you've alluded to, in the end, these things flush out bad leverage. And the bad leverage was the fact, and I've mentioned this many times, it's exactly the same as long-term capital. There was one person who was everybody's biggest customer, and either people went, la la la, I can't hear you, or didn't do good risk management. So once that customer starts getting recalled on some stuff, it daisy chains immediately on a scale that nobody could have imagined. And it's very different because it was made by human decision as opposed to algorithm, where everything that was DeFi was fine. Everything that was CeFi got nuked because there was human decision making in the process. And they were making irresponsible decisions with people's capital. And look, again, it's nothing new, I wouldn't say it's even nefarious. Humans just do this. They've done it forever. And I've just been observing it because one day that too shall happen. Is the private equity firms, Apollo and Blackstone and a few at Carlyle. These guys are every investment bank's biggest customer. And they all use leverage. Now, look, these are smart people with diversified portfolios and everything else.